Right now, the average savings account in America pays you 0.38% a year. That is the official FDIC figure for June 2026. Leave $10,000 sitting there for 12 months, and the bank hands you back $38. Now look at a 3-month Treasury bill backed by the same government that insures your deposit. In May 2026, it paid around 3.68%. Same safety. Almost 10 times the yield. Your bank knows this perfectly well. In fact, your bank takes your cash, buys the higher paying version, and keeps the difference for itself. There is one plain asset sitting in full public view that quietly funds the entire banking system. Most people never buy it directly. That gap between what the money earns and what it could earn is the whole story. So here's the question worth sitting with for a minute. If a safer, higher-paying version of your savings account already exists, why is your money still parked in the low one? Let's be honest, nobody at the branch is going to walk you over to it. Their job is protecting the spread, not improving your yield. And the cost of not knowing this is not dramatic or loud. It is quiet, which is exactly why it lasts. Say you keep $20,000 in cash, like a lot of careful, responsible people do. At 0.38%, that earns about $76 in a year. At 3.68%, the same $20,000 earns roughly $736. That is a $660 gap every single year for doing almost nothing different. Stretch that across 10 years with no fancy moves at all, and you have handed the bank thousands of dollars. Not because of any mistake, because nobody ever showed you the other menu. So stay with me all the way to the end. I am going to show you 3 things in order. First, the simple instrument itself and exactly how the spread works. Second, the precise mechanics banks use to keep your money sitting still. And third, the quiet habit wealthy people build around all of it. That last part is the one that ties everything else together, and it is not about already being rich. It is about a pattern almost nobody points out loud. By the time we get there, that 0.38% is going to look completely different. Let's start with the instrument itself, because it is far simpler than the name suggests. A Treasury bill is just a short-term loan you make to the United States government. You buy it for slightly less than its face value, wait a few weeks or months, and the government pays back the full amount. The difference between what you paid and what you got is your interest. That is the entire product. There is no catch buried in the fine print. In July 2025, the total market for these government securities was about $29 trillion, according to Pew Research. It is the largest, most heavily traded debt market on the planet, and the front door is a plain government website called Treasury Direct. Sit with that for a moment. The minimum to buy one is $100. Not $100,000, not some private banking threshold. $100. The velvet rope people picture was never actually there. Now here is where the spread quietly lives. When money gets deposited at a big bank, it is not really saving in the way the word suggests. It is a loan to the bank, and they pay almost nothing to borrow it. Chase, the largest bank in the country, pays 0.01% on its standard savings account in 2026. That is $1 a year on $10,000. $1. The bank then takes your dollar and buys the very same Treasury bills paying 3.68%, or lends it out to someone else at even higher rates. They collect the wide number, you collect the narrow one. It is the oldest business model in all of finance, and it hides behind marble columns and a very friendly app. That difference between the two rates has a formal name. Bankers call it the net interest margin. In the fourth quarter of 2025, the average net interest margin across American banks was 3.39%, the highest level since 2019, according to the FDIC. Picture a middleman who buys water from the public tap for a penny, then sells it back to you by the glass. That margin is the glass. Spread across trillions of dollars in deposits, 3.39% is not a rounding error or a small fee. It is the engine room of the whole industry. And almost none of it requires the bank to be clever or take a big risk. It just requires you to stay exactly where you are. And this is not some small side business for banks. It is the main event. Net interest income is the single largest source of revenue for most banks in the country. Bigger than fees, bigger than trading. Every dollar you leave in a low account is raw material for that income. Think of a deposit as a barrel of oil handed over for free, and the spread as the refinery. The bank does not need anyone's permission to run the refinery. That permission was granted the day the account was opened, and the money left sitting there at 0.38%. You might reasonably ask why the government pays so much more than the bank for what looks like the same thing. The answer is that the government is competing in the open market for money, out loud, every single week. It auctions new bills constantly, and it has to offer a rate people will actually accept. Your bank faces no such pressure from you because you are not shopping. You already handed the money over. One of them has to win that cash every week. The other one already has it, and it knows you probably will not move. And here's the part that gives the whole thing away. Banks do not just profit from treasuries, they lean on them. Government bills and bonds are the safest thing a bank can hold, so they sit at the very center of a bank's own reserves, quietly propping up the balance sheet. The asset the branch will never hand you a brochure. For is the same asset holding that branch upright. You are being kept one step away from the exact thing your bank trusts most with its own money, which raises a genuinely uncomfortable point. If the gap is this visible and the door is this open, why does the whole thing keep working so smoothly? The answer is not one dramatic trick. It's not one thing. It is a small handful of quiet, boring mechanics, and once you see them clearly, you cannot unsee them. The first mechanic is speed, or really the deliberate lack of it. When the government raises interest rates, Treasury bills reprice almost instantly because they trade every single day. Your savings account does not. Banks raise deposit rates slowly, reluctantly, sometimes not at all, because every day they wait is another day they keep the full spread. That is how the FDIC average crawled to just 0.38% while short-term treasuries were paying several times that. Imagine a store where the shelf prices update the second the store's costs rise, but your paycheck only updates once a decade. That lag is not a glitch in the system. The lag is the product. The second mechanic is friction. Moving money feels much harder than it actually is. There is a login you half forgot, a transfer that takes 3 business days, a vague background worry that treasuries must be complicated or risky somehow. So the cash just sits. Now, to be fair, people are slowly catching on. Americans were sitting on a record $8.3 trillion in money market funds as of May 2026, according to Bloomberg and the investment company Institute. That number is a good sign. It means millions of people have started reaching for higher, safer yield. But the mountain of money still parked in plain old savings accounts, earning almost nothing, is genuinely enormous. Inertia is the most loyal customer any bank has ever had. To see the scale, remember that the $8.3 trillion in money market funds is the money that already moved. The far larger pool that hasn't moved is still sitting in checking and low savings accounts across the country. That is the reservoir the spread is drawn from, and it refills itself every payday automatically whether or not anyone is paying attention. The third mechanic is language, and this one is the sneakiest of them all. Banks call your account savings, which sounds like it is growing. They advertise being FDIC insured, which is completely true and reassuring, and also quietly beside the point, because Treasury bills are backed by the exact same government. They offer you a high-yield account at 4.15%, according to Bankrate in July 2026, and they hope you feel clever for hunting it down, even though a plain government bill often pays about the same with fewer strings attached. The words are doing the heavy lifting the whole time. Let's be honest for a second. If the bank labeled it the account where we quietly keep most of your interest, you would move your money out by tomorrow morning. And watch how the good rate gets used as bait. A bank will dangle a genuinely high introductory rate to pull your deposit in, then quietly step it down a few months later, betting correctly that you will not notice or bother to leave. The high number did its job the moment your money arrived. The slow fade afterward is where the real profit sits. It is the gym membership you signed up for in January and stopped using by March, except here the gym keeps charging you and you keep paying without ever walking in. There is a fourth mechanic hiding underneath the other 3, and it is fees. That standard Chase account charges a $5 monthly service fee, unless you keep a minimum balance or meet certain conditions. Read that slowly. You can actually pay the bank to hold the money it is already earning a spread on. It is a little like renting out a car to someone. and also paying them a parking fee for the privilege. Most people never do the arithmetic because $5 sounds trivial. Across $60 a year on an account paying you a single dollar, the math quietly turns negative. And underneath all four mechanics sits one feeling the bank works hard to protect: the sense that your bank is somehow on your side. The friendly name, the local branch, the birthday email, it all nudges you to treat a plain business relationship like a loyalty. But the account does not love you back. It pays 0.38% whether you have been there 1 year or 30. Loyalty in this one specific case is just a slower word for staying put. So the mechanics are speed, friction, language, and fees. None of them are illegal. None of them are even really hidden if you go looking. They simply depend all day long on you not looking, which brings us straight to the people who do look. Because while most of us leave the cash sitting still, there is a small, quiet group doing something completely different with the exact same dollars. Here's what almost nobody tells you about how wealthy people treat their cash. They are not gambling their safe money on hot stocks or the latest story. With the money that is supposed to stay safe, they run the boring version on purpose, and they run it with discipline. They buy the short-term government paper directly, they collect the yield the bank wanted to keep, and they do it in a specific repeating rhythm. The tool even has a name. A lot of people have genuinely never heard. A Treasury ladder. You split the cash across several bills that mature at staggered times. One matures this month, one next month, one the month after. As each one pays out, you take that cash and buy a fresh bill at the top of the ladder. The ladder never really ends. It just keeps turning. They also quietly use other pieces you can buy from that same government website. Series I savings bonds, for example, were paying a composite rate of 4.26% as of May 2026, with a fixed rate of 0.90%, according to Treasury Direct. An I bond is specifically built to keep pace with inflation, so the money does not silently shrink in value while it sits and waits. It is not exciting. It will never once be a story worth telling at a dinner party, and that, honestly, is the entire point. The wealthy are perfectly comfortable being bored by the money that was never meant to be exciting in the first place. There is one more quiet advantage the wealthy lean on, and it is the tax treatment. Because Treasury interest is exempt from state and local income tax, a bill can be worth even more than its headline rate suggests, especially in a high-tax state. On top of that, they let the reinvestment do the compounding. A payment collected and immediately redeployed starts earning its own small payment, which then gets redeployed again. It is slow at first, almost invisible. Then, somewhere around year 7 or 8, the curve starts to bend upward, and the people who started early stop, having to try very hard at all. And none of this requires a private banker or a special account. The same Treasury Direct website with the $100 minimum is open to the person with $20,000 and the person with $200. The wealthy are not using a different door. They are using the same door you can use. They are just using it consistently, and they started before you did. But here is the real move, the one that actually matters, and it is not any single instrument at all. It is what they do with the small payments. Every time a bill matures, every time an interest payment lands in the account, that cash does not sit around idle for even a moment. It immediately gets fed into the next thing, another bill, a low-cost index fund, a down payment fund, the mortgage. Picture a set of buckets arranged down a gentle slope. The top bucket fills up, then spills into the second, which spills into the third, and on down the line. Nobody is standing there hauling water uphill by hand. The slope itself does all the work. Small amounts repeated over and over, always quietly moving into the next bucket. Notice what is missing from all of this. There is no timing. The wealthy are not waiting for a perfect moment or a market bottom to deploy their safe cash. The latter runs in a boom, and it runs in a slump, because its whole job is to keep the small payments moving no matter what the headlines say. While the rest of us wait for a certainty that never quite arrives, the boring machine just keeps turning in the background, one matured bill at a time. And that pattern, that one specific pattern, is the exact thing this entire video has been building toward from the very first sentence. Because in the end, it was never really about Treasury bills at all. Now, let's be genuinely fair about the downside, because there absolutely is one. Treasury bills are not magic. and I would be lying to you if I said the yield lasts forever. That 3.68% exists right now because short-term rates happen to be high. When the government eventually cuts rates, and at some point it will, newly issued bills will pay less. The 3.68 could slide to 2% or lower, and your whole ladder resets at that new, smaller number. There is also the lock to think about. A savings account lets you grab every dollar the instant it is needed. A Treasury bill ties the money up until it matures, usually anywhere from a few weeks to a year. If that cash is suddenly needed on Tuesday, a bill that matures in 3 months does not help you at all. And then there are taxes. Treasury interest is exempt from state and local income tax, which is a genuinely nice edge, but you still owe federal tax on what you earn. None of this makes the bill a bad deal. It just makes it a tool with real edges. Like every tool, the point was never that treasuries are perfect. The point is that the safe version of your cash has a higher paying door, and now you get to choose it on purpose. So here is the twist, and it is much bigger than any single account or bill. The reason banks stay so calm about all of this is that they understand one principle most savers never quite internalize. Real wealth is not built by making one big correct decision. It is built by owning things that pay you small amounts over and over, and then feeding every one of those small amounts straight into the next thing that pays you. That is exactly what the bank does with your deposits. It buys the 3.68%. It collects the small repeated payments across trillions of dollars, and it rolls every one of them forward, endlessly. That is the whole trick. There is no secret asset hidden in a vault somewhere. There is a secret behavior sitting in plain sight. Think about that for a second. The 0.38% account we started with was never really the problem. The problem is that the small payments were flowing in the wrong direction the entire time, out of your pocket and into the spread, and nobody ever drew you the picture. But once you can see the picture, you can point it the other way. You do not need to be rich to begin. You need to own one single asset that pays you a small amount, and a simple habit of sending that amount into the next one. Here is the line worth keeping. The wealthy do not chase big wins. They collect small payments and never stop feeding them forward. That is genuinely it. That is the asset and the behavior that banks would honestly prefer you never fully understand. Because the moment you do, you quietly stop being the source of the spread and you start being the one who earns it. Picture two neighbors, Dana and Marcus. Marcus keeps $20,000 in the same savings account his father always used, earning that same 0.38%, forever waiting for the perfect moment to finally invest. Dana builds a small treasury ladder, collects the payments as they land, and quietly feeds each one into a simple index fund. Neither of them does anything dramatic or clever. Marcus is not lazy, and Dana is not some secret genius. The only real difference between them is direction. 10 years later, Marcus has roughly what he started with, plus a little. Dana has a meaningfully larger number, built almost entirely out of small payments that simply kept moving. And remember those $38 the bank handed back on $10,000? Right at the start? Dana stopped accepting the $38. She went and collected the difference the bank had been quietly keeping. Same safety, same government. She just walked through the other door. If this changed how you see that 0.38%, share it with someone still stuck there, like this video, and subscribe.